Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And this week we are starting off our week after what was a difficult Friday. Yesterday, equity markets tried to rally back to recover some of the losses from Friday. Didn't quite get there, but we're opening up again this morning, slightly positive on the equity markets. So I think for a lot of investors, the question remains the weakness that we started this month on, very similar to the weakness that we started the previous month on, which was on the back of labor market data that came in weaker than expected. So going into the second month of weaker economic data on the labor side, do we expect further downside, or was the volatility that we saw on Friday an opportunity for buyers to step back in? When you look at price action from yesterday and today, it certainly seems to reflect a reaction very similar to what we saw last month, which was an initial sell-off followed by a pretty consistent buying from investors. So looking at the S&P 500, we talked about the fact that we managed to make ourselves back up to the 52-week high after last month's weak job numbers. This month, we had that same decline after the August job numbers came out, but obviously we didn't quite get as low. 5,100 on the S&P 500, we're nowhere near there. The question, I think, for a lot of investors is whether or not we do pull back to that $5,100 level, or does this equity market continue to zoom forward? I do think quite a bit of market sentiment is riding on the CPI print that comes out tomorrow morning. If inflation continues to come in cooler than expected, there certainly leaves more room for the Fed to cut 50 basis points with this cooling labor market. That is, I think, for what a lot of equity investors are looking for, is a bigger than expected rate cut, which would be overall positive for markets. I think that if we do get a bigger rate cut, we're likely going to see equities resume back to those all-time highs and potentially break out higher from there. But if we look at the NASDAQ 100, now the picture here for the NASDAQ 100 looks far worse. You have the 50-day moving average that's continuing to slope lower. We've mentioned the fact that the 50-day moving average sloping lower means that any breakout above the 50-day moving average is an opportunity to sell into, and that's exactly what we've gotten here. The question is just how far lower do we go? 425 here to the downside on the Qs, or is this now an opportunity for technologies to start bouncing after what has been a strong underperformance of technology relative to the rest of the market? Now, if you look at small caps, IWM, we continue to see small caps underperform the S&P 500. But on the recent sell-off here, it's provided a little bit of defense here on that sell-off recently. So IWM not selling off as heavily as the S&P or the NASDAQ, providing some rotation into some of these value-based names, which if you think about the lack of rotation that we've been talking about for 6 or 7 months going into the market peak, now what we're getting is that sector rotation that we were looking for, which overall, if we can get it and continue to get it, is a net positive here for the broader markets. And that's illustrated by the RSP chart. As you can see, the RSP chart has barely pulled back. It pretty much is hovering near all-time highs, really speaking to the fact that the sell-off is fairly concentrated in a few mega cap names, that the majority of the S&P 500 is not as weak as the higher beta growth names that have been leaving the markets higher here. So that overall is a net positive for the equity markets, that there's effectively what is broad participation, or rather the broader market is providing defense as the mega cap names pull back and provide some downside risks. Now, when we look at growth versus value, over the past year or so. Growth has outperformed value by a pretty significant margin, but over the past couple of months, we have really seen value outperform growth. So that has continued over the past few weeks and leads us to this current rotation that we're in, where value-based stocks are starting to lead growth stocks at the moment. This catch-up by value-based stocks is a necessary move for equity markets to resume another leg higher in a more healthy manner. So seeing that is certainly an overall net positive for the equity markets from what I can see. If you look at commodities, recently commodities has collapsed here below another support level. We'll take a look at some of the individual commodities here in a second, and I think this is sort of impressive to some degree in terms of the underperformance of commodities as an asset class, especially when gold hovers near 52-week highs. So gold continues to act as a safe haven as volatility increases and uncertainty increases. But if you look at commodities across the board, look at oil, we'll talk about that here in a couple of seconds, in a couple of minutes. Demand for commodities have been quite weak, really speaking to a weaker economic picture with regards to demand for commodities. So commodities breaking below major support levels when gold trading at all-time highs really speaks to the lack of demand for a lot of commodities at the moment, especially oil. The high yield corporate bond ETF continues to grind higher, meaning the bond market continues to price in no fears of recession and no major concerns from a credit risk perspective, which also is a net positive for equities. So what we're really seeing so far from the charts that we've looked at is really a sell-off on Friday that has so far largely been self-contained, and that risks for further downside at the moment is not showing up in other asset classes at the moment. You do have VIX retreating back below 20% here on yesterday's move. We opened the week at around 22. We are retreating back to below 20, which is also a potential signal that we have put in a tradable bottom for equities, as VIX kind of continues to recede a little bit here. You do have the 10-year yield holding steady around 3.7% here. That has been largely unchanged for a few trading sessions. You have this sort of double bottom, or you can think of this as almost like a double top on TLT. But right now, it looks like we are very much on the verge of breaking out above this double top here on TLT, which would point us to lower rates for the 10-year yield. That would align with expectations for the September 18th Federal Reserve meeting for the Fed to cut interest rates. The question for a lot of investors is whether we get a 25 or 50 basis point cut, and the CPI print tomorrow will largely play a role in solidifying a potential 50 basis point cut, which I think for a lot of equity investors, that is the outcome that they are hoping for, because a 50 basis point cut would be further support for equities going forward. Looking at the dollar index, we continue to trade off of this, call it 100.5 double bottom here. The dollar has seemed to, at least in the short run, found a little bit of strength here, but from my perspective, any strength is something to sell into. And I think long term, you're likely to see dollar revisit that 100.5 support level and crack below that as bonds continue to rally. So the US dollar, while holding itself up through that double bottom, I think long term it's very much in a bearish trend. If you look at gold, as we said before, gold is continuing to hover above 2,500, which is very much near all-time highs, continuing to provide that safe haven asset in this kind of market environment. And what's really interesting is the kind of the opposite chart, what we're seeing here on 52-week lows for oil. Um, Despite the fact that US consumers have nearly gotten back to 2019 levels with regards to number of miles driven. What's really interesting is the demand for oil is nowhere near the peak that we saw in 2019. And this could be due to the shift in electric vehicles over the past few years. This could be the shift towards more fuel efficient cars. But what we're seeing is that even though we are driving nearly as many miles as we were in 2019, fuel consumption, fuel demand is significantly lower. Um, this is a problem for OPEC nations. They were talking about ramping up production here. They've had to put those plans off as oil prices continue to decline. And they have to start looking at production cuts in order to find more stability with the oil markets at the moment. So in the short run, expectation for oil and energy stocks to maintain kind of a volatile market, but the downside risks, the risks are to the downside here for energy names and oil as a commodity. So looking at the individual sectors, this is really where we've noticed this on the back of the recent buying off of the July lows. So we started July fairly weak with the cooling labor market sparking recession fears. But quickly those fears receded and the markets traded all the way back to all-time highs. We find ourselves in a similar situation right now where the unemployment numbers from Friday have caused a bit of jitter in market participants. A lot of investors are a little bit more gun shy about investing, but what we're seeing is a significant amount of sector rotation. We've seen a lot of flow out of technology into nearly all the other sectors. So technology has continued to lose ground relative to the S&P 500, similar to the NASDAQ 100. The 50-day moving average is sloping lower here. Rallies into that moving average are shorting opportunities. And then there are opportunities to potentially follow a bearish trend with technology at the moment. But that outflows from technology has flowed into nearly all the other sectors. You have consumer discretionary that, as we've sold off, have basically just traded sideways. That has contributed to consumer discretionary outperforming the S&P 500, playing defense on the sell-off. Communications is one of the sectors that is alongside technology lagging behind the overall markets, but those are the only two sectors lagging behind. Nearly every other sector has gained quite a bit of relative ground, meaning provided some defense on the sell-off here. As you can see, XLF maintaining above this $44 kind of double top here that we broke out above from a few weeks ago. So far, it's come back to retest that level of support, and those levels have held. This certainly points us to potentially a higher environment for financials, especially as we are heading in for a potential rate cut in the Federal Reserve meeting in September. You have consumer staples that have broken out to new all-time highs and continue to move higher here. Again, playing that defense here relative to the S&P 500, effectively trading back to all-time highs. XLV Healthcare, same thing, trading near all-time highs as the S&P falls a bit, the NASDAQ and the Russell falls a bit. Healthcare gaining some ground here relative to the S&P 500. You have materials gaining some ground here relative to the S&P 500. You have industrials gaining some ground relative to the S&P 500. You have real estate gaining a significant amount of ground relative to the S&P 500. Notice the real estate sector is effectively at 52-week highs. So what was one of the weakest sectors have right now turned into one of the strongest sectors at the moment in this declining interest rate environment. That's kind of what we're seeing from real estate. As we said before, with energy shares near 52-week lows, this is going to continue to pressure energy stocks lower here. So as we look for opportunities in energy stocks, they're going to skew a bit more here to the bearish side than bullish side at the moment. And then lastly, you have utilities continuing to grind higher here as equity markets move a little bit lower, and that contributes to the outperformance of utilities relative to the S&P 500. And then looking at home builders, we have home builders that have largely stayed sideways here. As you can see, the 50-day moving average is sloping higher. It is holding above that 50-day moving average, which is a short-term net positive here for home builders. However, the same cannot be said about semiconductors. As you can see, the 50-day moving average slope continues to deteriorate. We've been talking about the fact that semiconductor trends have been deteriorating and doesn't look particularly well. The fact that it was rejected at that 50-day moving average a few weeks ago and is now trading significantly lower from that is also not a good sign here for semiconductors, and certainly opens the semiconductor industry to potentially further downside, especially given the valuations that a lot of these semiconductor stocks continue to trade on, with the assumption that growth will maintain and be strong there for the rest of the year and going into next year. And so far, those the corporate earnings have caught up with kind of with investor expectations. However, the question is whether or not that can continue going forward. So with that, let's look at some of the ideas for today. The first one I want to bring up here are some of the more defensive names. Kind of, if you look at the sectors that are outperforming here, you look at GlaxoSmithKline, pharmaceutical stock. What's interesting is that GlaxoSmithKline has continued to outperform the S&P 500 as the equity markets continue to decline. It has outperformed the S&P 500 by quite a margin over the past month or so, and continues to move higher here. My expectation is for GlaxoSmithKline to kind of revisit 45.5 and potentially break out substantially higher from that. And that's based on more so from the fundamentals. GlaxoSmithKline trades at about 9.5 times forward earnings, which is a very substantial discount to the industry. Industry average is about 17.5. So we're looking at nearly half the valuation of its peers. And then if you look at expected growth rates, not only are margins better than the industry, but expected growth, both top and bottom line EPS and revenue growth, is expected to exceed the industry. EPS is nearly double what the industry expectations are at nearly 14%, and revenue growth expected is about 5% versus the industry average around 4%. So when you have metrics that are that show a company is growing faster and is more profitable than its peers, yet it trades at a discount to its peers, those are the opportunities that I like to take on and have a lot more confidence in the views that I have from the technical chart. But in the short run, what you have is a stock that has outperformed the S&P 500, continues to run, and we're looking for that outperformance to continue going forward. Another name I want to take a look at is one that is very unlikely on your radar, and that's SBA Communications. They operate cell phone towers. This is a real estate REIT, similar to Welltower. They operate, about 40,000 cell phone towers across U.S. and Africa. And very similar chart to GlaxoSmithKline, where over the past couple of months, it has continued to outperform the S&P 500. As we're selling off in the S&P 500, we're clearly seeing outflow from technology into sectors and stocks such as SBA Communications. And SBA Communications trades also at a discount relative to the industry, even though it's expected to grow at a little bit faster than the industry, and margins are effectively in line with the industry. So when you're just as profitable as the rest of the industry, but you're growing faster, it's a stock that generally should trade at the very least around the industry average valuation, if not a little bit higher. But SBA Communications is actually trading at a pretty significant discount, nearly 33% discount relative to what is calculated as its fair value. And then you look at the chart, it clearly shows you that investors are paying attention to stocks like SBA Communications, which, like I said, is probably not on your radar and certainly wasn't on my radar until it popped up on a scan. And when we looked at the fundamentals and we looked at the technicals, it really looked like a chart that aligned on both sides, which is why I think it's worth pointing out. And then lastly, if you look at semiconductors, looking at NXPI, this is really one where we do see some further potential downside here. You note that yesterday's recovery on NXPI is still trading below that 230 double bottom support that has been broken on Friday's price action. This leads me to believe that there's potential further downside from something like NXPI. NXPI does trade at a discount relative to the industry, but growth rates are about half, if not a little bit less than half, for both top and bottom line relative to the industry. It is just as profitable as the rest of the industry, but the fact that it's growing at about half the pace, and if you look at revenue growth, it's actually only about a third of the pace of the average semiconductor stock. That really speaks to why NXPI trades at only 15 times forward earnings. But the other thing to factor into is that, if you look at NVIDIA, you look at, ARM or AMD or any of this, of the semiconductor chips that produce chips for AI training, there's clearly demand for AI, but NXPI produces chips for car manufacturers. So car manufacturing has not recovered to the same degree, and there's certainly further downside, in my opinion, for car manufacturers, which is why on the semiconductor side, I think NXPI recovery will not look the same as the rest of the semiconductor industry. Which is why we have a more bearish tone here for NXPI. With that, that covers what I wanted to share with you here today. Hopefully that gives you a better understanding of the bigger macro picture for equities and some ideas for today. Thank you so much and have a great trading day.